2 days before the new year, Scott Davison, CEO of the One America Life Insurance Company, did a press conference about increased mortality rates and how the life insurance industry handles an increase in death claims. The media added their own spin to Davison's words, resulting in a very different message, which gave the impression that life insurance companies are sounding the alarm as mortality rates increase by over 40%. After reading one of these news pieces, we personally wrote to Scott Davison to get the actual message from the horse's mouth. Within minutes, Scott responded. I'll share his reply with you in a few minutes, but first, let's take a closer look into the spike in mortality rates. First of all, the increased deaths are taking place in the age ranges of 18 to 64-year-olds. This means the cost of many of these death claims will be mostly absorbed by the employers who pay for the group coverage on this age group. Group life insurance rates are adjusted every 2 to 3 years, so we can expect group insurance premiums to go up in order to offset the rise in the mortality costs. This premium readjustment feature is unique to group life insurance. Whole life insurance rates are not readjusted this way. Once a contract is issued, the rate remains fixed regardless of mortality rates in whole life products. Of course, insurance companies are very alert and monitor mortality rates closely. Mortality rates vary significantly from year to year. For example, between 1935 and 2010, the mortality rate increased by over 1 million, but the risk of dying decreased by 60%. Because of this, insurance rates actually decreased over this time period, becoming less expensive. During the 2011 and 2012 flu season, 12,000 influenza deaths were reported. In the 2017 to 2018 flu season, there were 52,000 influenza deaths reported. This represents a 33.33% increase in influenza mortality rates between 2011 and 2018. And between 1950 and 1975, the mortality rates were higher than they are today, even though mortality rates overall have been steadily declining since 1928. So we can see that fluctuating mortality rates are normal, and this is something the insurance companies are statistically very good at working around. The recent media-led panic about a life insurance company sounding an alarm over a 40% increase in mortality rates in the third and fourth quarter of 2021 must therefore be taken in balance. This is a good time to step back and not lose sight of the forest because we're too busy gazing at an individual tree trunk. Most of the deaths causing this death spike are not COVID deaths. In fact, the CDC data shows more deaths are the result of other causes and not COVID. The chief medical officer of Indiana says the majority of people being hospitalized are non-COVID related, and other state hospitalization rates reflect similar situations. Now let's take a look at Scott Davison's response to our questions concerning this spike in mortality. He says, "This is limited to our group benefits business, which insures working-age people, and is our smallest business by far. There will be no impact to individual contracts. We expect the increase in mortality costs to exceed $100 million over the next 3 to 4 years. For context, we paid 3 times this amount post 9/11. He goes on to say, "We are built to absorb large financial shocks. In fact, we expect them. Our overall financial strength is untouched. We are highly diversified, which greatly helps in times like these. This is a human tragedy, but not a financial tragedy for us. Our job is to be there with benefits when needed, no matter what. We hate the heartbreak that our clients are experiencing, but we are proud to be the financial first responders to enable their families to start to rebuild their lives." From Scott's response, we can see there is nothing to panic about. He clearly says, there will be no impact to individual contracts. Our overall financial strength is untouched. Of course, death rates will continue to fluctuate, rising and falling as they always have. Insurance companies perhaps know this best as they're always carefully planning and preparing so they can remain strong during times such as these. As a matter of fact, insurance companies actually build their business model around the probability of these things occurring, just like Scott said. We are built to absorb large financial shocks. In fact, we expect them. This makes insurance companies more reliable even than the market when it comes to providing guaranteed whole life contracts that build cash value for people to borrow from whenever necessary, and also provide a death benefit for their family. Our job is to be there with benefits when needed, no matter what. We hate the heartbreak that our clients are experiencing, but we are proud to be the financial first responders to enable their families to start to rebuild their lives. The take-home message is this: death is something we will all face sooner or later. Life is a gift. We should learn to live each day with gratitude and expectation, working towards a better tomorrow because of what we do today.